Welcome again. Welcome back, everybody. In our last class, we talked about the bullish word, the bull word, and the long word. We are still on that, talking about, we're discussing trading terminologies that you're supposed to be acquainted with. So, the next thing we're supposed to discuss is brokers and market spread. But I also want to state something, that the bullish and the buy and the long word, those words that we talked about the last video, if we were talking about selling, the opposite of the explanation, that is what selling will be. So then where we have buy for sell, you know what sell is. Where we have bullish, for the sell word, it will be bearish, bearish, like like a bear, then ish. Then when we have long, it will be short. So if you say a commodity is bearish, or a commodity is we are going short, or a commodity is going bearish, it means we are hoping that the commodity drops in value. Okay, we are hoping that the commodity drops in value, so that when we sell, we're hoping that the commodity drops in value so that we can make profit off of it. So basically, short, sorry, selling short, and then bearish are the opposite of the last video that I dropped. So without, if that's completely clear, let's just move into this next term called brokers and market spread. Sorry. Now, when you want to, like, when you wake up, let's assume that you're already a trader, okay, and then you want to actually trade in the market, like you want to participate in the market. Back in the I think in the 90s or the early 2000s, the only people that were actually permitted to take part in the Forex market were actually only the banks, not just banks, major banks. I don't even think commercial banks used to be allowed. And then back in those days, unlike now that we have a better technology and we have apps that you, like a MetaTrader, that once you just enter, you can buy from the comfort of your home. Back in those days, if you want to buy a commodity or a pair, you have to call the bank. First of all, you have to, let's say you want to invest in the US dollar now, okay? You have to call, and then your bank is in like your bank is GT. After funding your bank with naira, with, let's say, your 10 naira that you want to use to buy your dollars, if you wake up that day and then you want to participate in the market, you'd have to call your bank. So your bank is the one that would now execute that order. We individuals, we were not allowed. Even little microfinance banks were not allowed to take purchases, except hedge fund banks, all those big corporations, then central banks. Because back then, the technology had not made it seamless for anybody. You see, so it is. Just imagine being back then, where you have to take 5-6 trades a day, and then when you place a call, there are about 1 million people also placing calls all over the world. There's a popular thing they call Wall Street. I don't know if you've heard of it. But that's Wall Street is like, it's like, we used to be like one of the most popular places where Forex used to be traded for the American society. You know how the United States has been, they're always in the forefront of everything. Everybody assumes that the United States is the number one representation country in the world, which is why most examples or anything usually has to do with them. So that's why the popular word Wall Street is just an institution in the United States, because they were one of the first to start after the trade by barter era, where you give me yam and collect beans, and then money was invented for the services of value. The United States, the stock exchange, Forex, and all of that, and the ideology of even banks, is they are the one that started. They are the pioneers, basically, according to history. They are the pioneers of how we started. Anyways, we're digressing too much. Our discussion is, we're talking about broker market spread. Now, in the ideology that I gave you, by yourself, if you want to buy dollar, because of how technology is today, you can simply tap your phone, tap an app, look for whatever I don't know, whatever company you can that offers that service. You do not need to go all the way to look for the physical currency. So if you want to buy dollar, you do not even need to have the physical currency. You can invest in it without even stepping out of your house. But then how is that made possible? It's made possible by what the world we call it is made possible by the word we call brokers. And so let's say just they are simply middleman that connects you, whether you are buying or selling. Your broker is like your intermediary between you and the market. Okay, there is you, the individual, the retail trader, and then there's the big markets where the entire flow of money is represented by either your bar chart or your candlesticks, and then the person that connects you when you want to buy whatever app you tap. You understand? Whatever app connects you to the open market is what we call brokers. In the ideology I give with GT Bank and then the market, you would be the retail trader, GT Bank will be your broker, and they are the one that will connect you to the dollar market, so that when you tap buy on your GT Bank app, they will actually be placing the order but representing you. That's basically what brokers do. It's that easy. So let's say if you want to invest in the US economy, you're not even in the US, you're not even in the continent, you're not close to the US. But because of your broker is the person that would whatever currency. Thankfully, technology has made it easy that whatever currency in the entire world you want to invest in today, just all you need is just a flick of your fingers and your apps that you can be making millions. That is why Forex is usually arguably one of the most comfortable careers that you can meddle in if you know how to trade. If you're good at it, it's quite comfortable. It's quite convenient. You can be trading from your toilet. You can be trading from an airplane. You can trade for only 5 minutes a day. You can trade for like 1 month. But when we enter types of traders, I'm going to break down that aspect too. But for now, let's one at a time now. Let's still discuss about brokers and then market spread. Now, I believe you understand what broker is. Broker is just like the middleman between you and the market. Okay, and there are different brokers in Africa. We have a lot of brokers in Africa. We have a lot of brokers even in Nigeria. When we're talking about apps, those things would be recommended for you guys to pick by yourself. When I'm talking about apps, I'm going to list out a few brokers, their pros and their cons, and then you would pick out one by yourself. And then when we are discussing how to place trades and demo accounts, don't worry, I'll make it a fun class. It's going to be quite interesting. Anyways, let's talk about the market spread that's on our screen. The market spread is simply the charge for your brokers. It's that basic. As complicated as the word seems, the market spread or something, it's simply just the charge for your brokers for connecting you to the market. Now let's say you want to buy dollar at 10 naira, okay, and then you open your GT app, assuming GT is a broker. That's what we're doing. At GT Bank is not a broker. You cannot buy dollar through your GT Bank app and call them a broker. But for the sake of being basic, we're going to represent GT Bank as your broker. So now when you want to buy, you want to take your trade today, you want to buy buy dollar, knowing that the dollar is going to increase in price. So you want to buy it here, and then when it increases in price, you're going to sell it off, and the difference in value will be your profit. If you go into your bank, and then if you go into your app and then you tap buy, your broker is one that connects you to the markets. All right. Now, I said market spread is simply what the broker charges you for connecting you or for placing your transaction on the market, right? But then how does that market spread work? Let me break it down for you. If the charge for your broker is about, like, let's say 2 naira, how do they collect the 2 naira? They do not when you have 10 naira in your account, okay, they do not remove that 2 naira charge, leaving you with 8 naira. What they actually do is, when you execute that buy order, the market spread is basically the market spread is like the value that they would allow the currency to reach before they will execute your trade. Let me explain. You see, pick two numbers, 10 and 12. 10 is where your dollar is at. You're buying at 10 naira, but your broker is charging 2 naira. Rather than removing that 10 naira, 2 naira from your 10 naira, they'll rather wait for when you buy and there's an increase in value. So when you have bought and there's an increase in value, okay, and maybe let's say you buy at 10 naira and dollar is at 13 naira, but your broker is charging 2 naira. So rather than remove their charge from your money, your equity, we call it equity or capital, before you buy or sell, rather than charge you before you buy or sell, they'll actually wait for you to buy, okay, and then the market spread, which is their charge, is what they would take after you have executed it. So if you buy at 10 naira and the value of what you bought goes to 13 naira, and then your broker is charging 2 naira, your broker would not give you any profit. You see how complex it is. Your broker will not register your trade as any profit until the value of what you bought has passed their spread. So if they are charging you 2 naira, they are not going to, when you buy at 10 naira and then the value increases to 13 naira, your broker, when your broker takes out 2 naira from that transaction, you do not make any money until the value of your 10 naira USD reaches 13 naira. And when it reaches 13 naira and your broker has taken out 2 naira, so rather than your value, your profit being 3 naira increment, it is going to be 1 naira. That's simply how brokers take their commission. As much as it is used to protect you, your brokers are also human beings. They're also organizations that use the money you keep in bank to trade too. So they also look out for yourselves. So the crazy thing is that you see that your broker's the spread, which is the money that your broker is asking for, the money that is charging you for whatever execution it is, whatever execution you are making, depending on buying or selling. If you buy at 10 naira and your broker's charge is 2 naira, as long as you have executed that transaction, okay, if the market now actually falls down in value instead of going upward, which you're hoping it does, it falls down in value, your broker is still going to charge you that 2 naira. Whether if you buy or you sell, whether you are making money or you are losing money, your broker's percentage is in the moment you execute an order, your broker's percentage. When we talk about trading apps and we talk about MetaTrader, you will be able to see there are lines that your broker shows you each day to know what the spread for the day is like. And spreads are not it's not a fixed amount. It depends on the volume of the amount of value of that currency in the market. Every single 24 hours, your broker will decide what their spread will be for the day. But their spread is usually very small, very, very, very small. The ideology of buying at 10 naira and your broker charging you 2 naira, most times the broker will charge you like 10 cents or 10 kobo or 50 kobo. That's what they will charge you. But then 50 kobo, if they are handling like a million users, 50 kobo by a million, they make their money. So even as much as they charge you, brokers also have like their own policing system that there's a particular amount of charge that they are not allowed to go above. So there are policies even for your brokers. So they cannot always just wake up every morning and then they will charge you like half of what your equity is or half of what your capital is. They also have their own rules and regulations. But the point is that the money that your broker charges you, which is your market spread that we're discussing brokers and market spread. The money that your broker is charging you, okay, whether you are going to be buying or selling, you would not be charged until you execute the order, and then the increment in or decrement in value of what you are doing. That's where they usually take their trade for, just to save their own ass. So when you are making money, your broker is making money. When you're losing money, your broker is also making money. That's just the law. That's just the rules of the game. When we divert into SMC, I will talk about manipulation of the market, how the market is rigged to not be in your favor. When I open you to a new world, don't worry, those ones are complex classes. When I open you into a new world called SMC, you'll understand how the flow of money and the people, the market makers, the big sharks, they are out to eat you. So then SMC is like outsmarting the big sharks in the game. I'm digressing. We're still in the basic class. I'm digressing. We're still in the basic class. Anyway, so I feel like that is easy to understand. But if there are any questions, like I always say, you keep them by the time when we're supposed to discuss it. You drop it. I will re-explain it again. So let's summarize a little bit. Let's see what we've learned today. We've talked about the terminologies. We've talked about buying. We've talked about being bullish. We've talked about longing. We've talked about how the term bullish was formed, and I also explained the opposite of that would be selling, bearish, or short. Okay, and then we've talked about brokers, how they are the intermediary between you and the market, meaning middleman, and we've discussed the market spread, meaning the market spread is simply just a charge, and we just finished explaining how they actually charge the market. So if you have 10 naira in your account, you are going to invest in the dollar. Your broker is not going to charge you until you have actually executed your transaction. That way, they are trying to say they would also be risking. Once you start risking, they will not let you. Basically, what that market spread is trying to identify is that once you enter the market and you risk by executing a trade, that's when they will join you. They will not let you be on your own and then you lose your money without seeing your broker lose. But on the clear picture, that's not actually how it works. They are not out to help your ass out. They are going to charge you whether you make money or you lose money. That's why a lot of people that come into Forex without good or sound skill blow their house rent, blow their life savings, and then they will go out and start cursing that Forex is a scam, this and that. If you do not calm down to learn it, Forex is going to eat your ass out. There is no easy way, there is no escape, there is no short way. It's not gambling. It's not a betting scheme that you can 1-2 weeks you can get lucky. If you don't put in the time to learn it and be skillful, there is no inshallah in Forex. I'll keep repeating that thing to you like that. There is no inshallah in Forex. You have to do your homework, meaning you have to study and you have to analyze. Right, with that, I hope that everybody understood what this class was. If there's anything you don't understand, as usual, I've always said, write it down and then ask questions when it's time for us to ask questions. With that, I hope everybody has a good day. If after the video we're able to assimilate fast enough, I might make another video later today and then take questions for everything, depending on how fast you guys learn. So with that, let's move on. Thank you.